Hi, welcome to MBA Alpha, where we explain topics found in the MBA curriculum. If you are not an MBA student but are interested in business topics, you will probably still find this content helpful.
This video is about one of the methods that can be used to generate profit from trading stocks. One of the ways to profit from trading stocks is to find stocks currently trading below their intrinsic value, buy them, wait until they rise to their intrinsic value, and sell them for a profit. If you need to become more familiar with the term intrinsic value, the intrinsic value of a stock refers to the true or inherent worth of a company's stock, independent of its current market price. It is an estimate of the actual value of the company's stock based on fundamental factors such as its financial health, earnings potential, growth prospects, and other relevant metrics. But how do we calculate the intrinsic value of a stock so that we know if it is currently trading below its intrinsic value? There are several methods, and in this video, we will outline the steps to using the Gordon Growth Model to estimate the intrinsic value of a company's stock. The Gordon Growth Model is a method for valuing a stock by assuming that dividends will grow at an approximately constant rate indefinitely. Therefore, this method only works for companies that issue dividends that grow at an approximately consistent rate. It's challenging to provide an exact number of companies that consistently issue dividends with an approximately consistent growth rate, as this can vary over time and is subject to changes in company performance, economic conditions, and other factors. However, many well-established and financially stable companies aim to maintain or increase their dividends over time. These companies are often referred to as dividend growth stocks, and the intrinsic value of the stock of these companies can be analyzed using the Gordon Growth Model. Here is the Gordon Growth Model formula. We are solving for P sub 0, which is the estimated intrinsic value of the company's stock price we are studying. To use the Gordon Growth Model first, you must choose a publicly traded company and a business data and analytics platform to gather your company information. Some examples of business data and analytics platforms that can be used are FactSet and Morningstar. I will put links to FactSet and Morningstar in the video description. Second, using your chosen data platform, find the dollar amount of the last dividend that the company paid. Third, locate the dividend history of your chosen company on your data platform. Find the previous 5-year average and use this as your growth rate. Fourth, determine your ideal rate of return. An investor's rate of return is the percentage gain that an investor wants to receive for taking on the risk of the investment. It is a measure used to evaluate the profitability or performance of an investment over a specified period. Now you need to plug these values into the Gordon Growth Model formula. Here is the formula again. P sub 0 is the price you will compute as the stock's intrinsic value. D sub 0 is the last dividend that the company paid. G is the growth rate that you previously computed. R is the rate of return that you decided was ideal. Let's say that the last dividend that a prospective company paid was $2, and the dividend amount has grown consistently over the previous 5 years by 5% per year. Additionally, let's say your ideal rate of return is 10%. Let's plug these values into the formula and find out what the intrinsic value of this stock might be. As you can see, on top, D sub 0 becomes 2 and then is multiplied by 1.05 to become 2.1. On the bottom, R equals 10%, entered as 0.1, and G is equal to the growth rate, which is 5%, entered as 0.05. 0.1 minus 0.05 is equal to 0.05. Therefore, the value on the bottom is 0.05. Then our equation is 2.1 divided by 0.05, which equals 42. Therefore, P sub 0 is equal to $42. We can find the stock's current price and compare it to our calculation. The stock may be undervalued if the stock price is less than $42. If we buy the stock now at the undervalued price, it may rise to find its intrinsic value, at which point we can sell the stock for a profit. While this is one method of finding undervalued stocks, our analysis is the strongest when using multiple methods. Other methods for finding undervalued stocks include estimating the stock's intrinsic value using financial ratios, such as the price-to-earnings ratio and the price-to-book ratio. If you found this video helpful, please like and subscribe or follow, as more videos about MBA topics will be posted. Additionally, Please share your thoughts about stock price analysis in the comments below. Thanks for watching and have a great day.